Welcome back to the Compassionate Capitalist Show. Of course, I'm Karen Rands, and on the show, we talk with guests about secrets, their inside secrets to creating wealth through funding innovation, providing resources and experiences necessary to grow those companies to profitability and powerful exits to create wealth for all those involved. You can learn more about me and connect with me at cougarrand.com, and more easily is karenrands.co. Of course, all the links are in the show notes. And when you visit my site, you can sign up for tips and insights and emails and my free ebook. So my guest today is really legendary, and many of you are going to be familiar with Brad Feld because of just the so much that he's been involved in. Two of the things that you're going to hear about are just definitely the headline kind of stuff. So first of all, let me explain in case not. Brad has been an early stage investor and entrepreneur since 1987. That's an interesting time because some of the big name IPOs were going public at that time, but also Black Monday, the legendary stock market crash. So we'll talk about that. And you most likely are familiar with the Foundry Group, also known as Foundry VC, as the anchor organization. It's described as a network-driven venture capital ecosystem with 45 firms, 100 general partners, and 1,900 companies. A lot of those are portfolio companies, and we'll touch on that as well, and the impact and strategy for that ecosystem. Prior to co-founding Founder Group, Brad co-founded Mobius Ventures Capital, and before that, Intensity Ventures, but also co-founder of Techstars. And I'd be real surprised if my audience isn't familiar with Techstars. It's hard to imagine that, but it's one of the largest pre-seed investors in the world with a 96 billion all-time accelerated portfolio market cap, a unicorn in its own right. The website, just so many resources on there. It's at techstars.com. And of course, Brad is a writer and speaker on the topic of venture capital, investing, and entrepreneurship. He's written a number of books. It's a series called the Startup Revolution series. And he also has a new book out that is about, I guess, an update to a prior book on boards and how to form boards, how to be on boards, and the best practices for boards that are really critical to entrepreneurs as they grow their businesses. So with that, welcome to the show, Brad.
Karen, thanks for having me.
So let's see, you graduated from MIT with the Bachelor of Science and Master of Sciences. And did you see yourself when you were, this twinkly eye student there, or an alum at the forefront of innovation and venture finance when you were there at MIT?
Well, I didn't envision myself being at the forefront of it, but I never thought about working for a company. So when I was in college, I started my first company, and I actually had a couple of companies I started in school that failed before the first company that actually turned into something that was successful. I'd also worked for two companies. One, the summer between my junior and senior year in high school, I went to London and lived in London for a summer and worked for a company called Centronics that was an important early tech company sort of in the personal computer world, because they really were one of the first printer companies making dot matrix printers. And so I had an entrepreneurial experience with them because, they were growing quickly and they were expanding. And then between my senior year and my freshman year in college, and then, for several years after that, I worked for a husband and wife team, Chris and Helena Aves, who had started a company. I was their first employee that wrote software for the PC for the oil and gas industry. And that business, I continued to work for them, in the summers full-time, and full-time being 80 hours a week. And during the school year, maybe I worked 5 or 10 hours a week for them. And I wrote a couple of pieces of commercial software that they released. And they paid me, in addition to paying me $10 an hour, there wasn't really the concept of royalty or of equity in that time frame, or certainly from them. But because it was the oil and gas industry, the concept of royalty existed. So I got paid a 5% royalty on all gross sales of the software that I wrote. And as a freshman in college, I'd get a check every month for my royalties, and sometimes it would be $1,000 or $2,500. One time I got a check for a little over $10,000, and I took everybody in my fraternity across the street to the Chinese restaurant for dinner. And after paying for dinner for everybody, I still had $8,000. So like I had this sort of early experience, not of having a job and really working for someone, but creating my own stuff from scratch and having that translate into things really working.
Okay. Yeah. So what was that first company that was successful?
Well, first company was very creatively named. It was called Feld Technologies. It followed two failures. Failure immediately before it was a company called Data Vision, and the failure before that was a company called Martingale Software. So Martingale was a company I started with my some fraternity brothers, including my partner and co-founder of Feld Technologies. And then Data Vision was a company I started with someone who was a client of that first company, Petcom, that I worked for, Chris and Helena. The arc of that, though, for that first company is I'd started doing consulting in school, and at some point I realized that instead of doing consulting as Brad Feld, I just start doing consulting as a company. So I created this company, Feld Technologies, and when I was my fourth year, when I was a senior and in graduate school, Dave Joke, who was my first partner, who was working for a startup at the time that was maybe went public a year or two later. So it was a pretty fast growing startup. He was one of their early employees. He and I joined up and we started the business. And that business grew pretty steadily for 7 years. It was self-funded. We never raised any money. We funded it with $10. We had 10 shares of stock. Each share of stock cost $1. I had 6 of them. Dave had 3 of them. And my dad, who was an advisor to us, had 1. And when we sold the company in 1993 to a public company, we had 10 shares of stock. And fortunately, they were worth a lot more than $1 at that point. But that was really that first arc. Like, we woke up every day and we had to make payroll every 2 weeks. Like we had to make money, and, we couldn't hire a person unless we had confidence that we're going to have enough money to cover sort of that next person in terms of their head count with regard to the business that we had. And we just, we learned everything just by doing it.
Wow. So you say you sold that in 1983, but you got started in, 1993, but you got started in venture investing in 1987. Is that right?
No. So the company started in 87. Officially, that's when Dave joined. We sold it in 93. I knew nothing about doing deals, investing as an angel, buying, selling companies, nothing, zero. I was really lucky. The company that bought ours was very acquisitive. And the 2 co-founders, who were the co-chairman of the company, who drove most of the deal activity, really took me under their wing. I became the technical guy on the deal team pretty quickly for them as they were buying companies. And at the same time, after about 9 months of like getting my feet on the ground and sort of settling into, this new thing where I was no longer CEO of what was, we were a little bit over 20 people prior. I became a division within this larger company. In that 9-month period, we grew to about 50 people and had a lot of very fast growth. And then the parent company bought a much bigger version of what my company was. And we merged my 50 people, $5 million or so business into that much bigger version. And then I spent all my time working on the deal side. At that point, I started making angel investments, and I knew nothing about making angel investments, but I felt like I didn't have any people reporting to me anymore. I had kind of a staff job in this company, and Len and Jerry were the 2 co-chairs. They were also doing personal investments, and they were very interested in, doing stuff with me, especially on the internet front. And I made, in a 3-year period, about 40 angel investments between 1994 and 1996.
Wow.
All software internet related, really at the very beginning of the rise of the commercial internet. And along that path, I got involved in a number of companies that raised venture capital. I was living in Boston. I knew the venture capital industry. A number of Boston-based VCs were clients of my first company because of the kinds of software that we wrote. We'd written some software for a few VC firms. And the net result of that was I ended up getting connected with this, at the time, relatively little known Japanese company called SoftBank. And they were just starting to buy companies in the US and make investments in what at the time was called digital media, but quickly became called internet companies. And I accidentally ended up doing venture capital. Like, it was not a deliberate path for me at all. I didn't really think about it. I just all of a sudden was, shifted from making my investments with my own money as an angel investor into now being a partner in a fund, writing larger, raising a fund, writing larger checks, but continuing to behave, frankly, a lot of the same ways I was behaving as an angel, which was, very early investor who was actively trying to work with the founders to help them be successful as they tried to get the company off the ground.
So you said that was around 1994 that you started angel investing?
Yep, 94, 94, 95, 96.
Okay, so what was did you, because you've always been on the West Coast, so like, were there mentors around you? Were you part of a group that you learned how to do that, or did you just sort of trial by fire? Because that's how did you figure it out? If you hadn't raised capital yourself to even know the questions that angels ask and what they're looking for, I guess it was really on the acquisition side. You kind of knew how to filter through that. Just explain a little bit of that, because it's so fascinating to me how people discover that they can invest in companies and the power of that. And it's more than just making money. A lot of times it's a shared interest in the passion that the entrepreneur has, but it's also, it's easy to get caught up in the emotion and the excitement of that and miss some of the red flags that might derail a deal or to keep it from scaling.
Yeah. So if I put it in context, in 1994, I was still living in Boston. And at the end of 1995, my wife, Amy Batchelor, told me she was moving to Boulder and I could come with her if I wanted to. And so we moved to Boulder in November 95. And then we raised the first SoftBank fund that we raised was raised in 1997. I don't remember when and during the year. So, 94, 95, 96 were investments at the angel stage with my own money across the US. So I had, Boston-based network where I lived. I moved to Colorado. So obviously I started to get to know what was going on in Colorado pretty quickly. My first company did a lot of work with Microsoft. So I had a very deep network in Seattle and spent a lot of time in Seattle. I had a lot of network in the Bay Area and LA. I grew up in Dallas, Texas. So I had some connections in Dallas and Austin. And kind of my mental model for investing, and of course, then the relationships I have with MIT and MIT undergrads and grads,
Sure.
of which, there tends to be pretty good connectivity as people, graduate and start to move across the country into different places and do different things. My mental model when I started investing was pretty simple, as I was focused on two things and two things only. And those two things were the people and the product. With regard to the people, basically, did I want to be partners with them? And I knew that I would be a junior partner or minor partner because I was an angel investor, but I'd be a partner, equity owner in the company. And, did I want to work with them and did they want to work with me? And the intensity or level of that work varied. So, in a handful of companies, an example would be NetGenesis, which was my very first angel investment. I was chair of the company and I helped co-found the company, even though I wasn't, if you say, who are the co-founders, maybe I'd be listed, maybe I wouldn't. But at the very beginning, I was deeply involved. My first check with a guy named Will Herman, who is another angel investor, that was his first angel investment as well. We did a ton of angel investing together. We were very involved in helping get the company going. That would be one end of the spectrum. The other end of the spectrum is I'm not going to remember the names anymore because too much time has passed. But a lot of companies where I would write a check because somebody else I knew was investing in the company and they were credible to me, and I was interested in the people and then the product. And it wasn't that I had to be a daily user of the product, but I had to actually be interested in it. It had to appeal to me somehow. In 1994, there were very few angel investors. It was not anything like what it looks like today. There was not a lot of knowledge about how to be an angel investor, and there was a lot of information asymmetry that existed between VCs and the companies they funded. The only people that tended to sort of have an understanding of how that stuff worked, other than multi-time entrepreneurs, were a couple relatively small number of lawyers who did work for startup and tech companies. And on the West Coast in the Bay Area, there was a group, and in the East Coast in Boston, there was a group. I was really fortunate that I met one of them very early on, a guy named Joe Hadzima, who I actually ironically saw a week ago. We just crossed paths when I was in Boston. Who was a lawyer that loved to work with very early stage startups in his practice, and he was figuring it out as well, because it was evolving away from this sort of very difficult to do, ponderous thing to still a pretty ponderous thing on a relative basis in 1994. But sort of like, here's the framework, like, here's what you're going to do. And this is what you're going to do to set yourself up to raise money from the next round, which would be the VC round. So a lot of it was just learning by doing. Now, I did about an investment a month. And in that time frame, an investment a month was considered insane.
Yeah.
And I don't, some people think that's way too many today, but there's a lot of angel investors who make 10, 15, 20 investments a year. But at the time, the idea that you do a dozen investments a year was ridiculous. And my view was quite simple, which is that I figured out a budget, how much money I had that I was going to invest as an angel.
Mm-hmm.
I then said, okay, I'm going to deploy this money over 3 years. I just made up the number 3. I didn't know whether it was 3 years or 5 years, but I'm like, 3 years seems like forever, so I'll use that number. And then I decided to write the same size check into every company that I invested in. And then I knew for some of them, I'd write that check again, because my strategy at the beginning was, if the company's making progress, but hasn't been able to raise, their next round yet, which for me, in almost all those cases, was a venture financing. If I was enthusiastic, I would offer them another check of the same size, but at the same terms that I wrote that first check in. And sometimes people took me up on that, and sometimes they didn't, and sometimes that worked, and sometimes it didn't. But I had a very disciplined approach, but with this idea of very consistently, some months I do 2 and some months I do none, but I didn't do 5 and then spend 5 months doing none. It was a very sort of steady flow of investing activity. And of course, within, 6, 9 months, a lot of people had heard that, I was an active check writer. So a lot of entrepreneurs all of a sudden started showing up in the networks that I had. I was very visible and very active in the work that I was doing, both as for the public company that I was still part of, but also in the Boston community, or whenever I travel, I'd always make sure that I had some time to meet with folks and do stuff. And it just sort of took off from there.
Yeah. Yeah. So interesting. At the top of the show, I said 1987, but that doesn't really sound right. That's something else. But you talking about in the book. I talk about in my book, Inside Secrets to Angel Investing. I talk about this whole market as it evolved, and the access to capital that went from those early IPOs of like Microsoft and Charles Schwab was in 87 through the mid 90s, when it kind of really started, because you started to have a few people that had exits and tech companies that had exits. And so it started to create this ecosystem. And of course, you were, connected in all the key areas that were, Dell out of Austin at the time. And, Boston is often thought of as sort of like a sister region to Silicon Valley, because you had the very early tech kind of companies coming out of the Boston area. And so, that's really fascinating. So leading in, of course, we know what happened in 2000 with the dot-com bubble. So were you on a trajectory with lots of exits happening prior to that, and any anticipation of that was happening, or did it, kind of, did that bubble pop on you as well, or were you sort of, I see this happening, I'm gonna coast now?
It popped on me hard. I didn't see it.
Okay.
When I think back, I'm 57 now, so I think back on the cycles. Like the cycle from 87 for me. I mean, I remember Black Monday really well, because we had started our company and we had some clients, and the stock market drops 25%. And I was living in Boston, and Boston had this thing called the Massachusetts Miracle. And Michael Dukakis, who was the governor, had created this incredible, miracle of economic wonder that really just it fell apart right after that time frame. And the ignominious sort of collapse of the Massachusetts Miracle between 87 and 90. I don't think it was a despondent kind of time in Boston, but like the momentum that was building prior just evaporated. And business was hard. So I sort of had to go through that in my first company. I wasn't that aware of it. Like it was part of the environment. Like, okay, this is going on. You sort of pay attention to it, but all right, go deal with it. In the internet bubble, what happened was, I funded a bunch of companies as an angel in this time frame. Then I started doing venture investing starting in '97. We raised a lot of capital at that first fund, which was called SoftBank Venture Capital originally, and then we ultimately changed the name to Mobius Venture Capital. SoftBank was our sponsor, but it was a separate fund from SoftBank. And we raised a $300 million fund in '97, a $600 million fund in '99, and a $1.25 billion fund in 2000. And if there's a really useful lesson in there that's playing out again in this market cycle, which is that we deployed the entire 1999 fund, $600 million in 9 months. And with the benefit of hindsight, that was idiotic. And it was idiotic because there's absolutely no time diversity on those investments. And so as a result, we had a portfolio that basically invested at the top of the market and then had all these companies that basically just blew up as the market fell apart. Our 2000 fund, we probably blew up a couple of $100 million the same way, where we just literally had, we were fortunate as the bubble started to burst to slow down our investing pace. And we ended up committing that fund over a 5-year period. But like the idea of committing a fund in 9 months was crazy. And I had started a couple of companies and I was co-chair of a couple of companies, including 2 that were public. That time period for me was so incredibly formative. I had a lot of financial success leading into the bubble. I had a lot of companies from my angel investing go public. I was not of the view of hold the stock forever. I had lots of companies that got bought for cash, so there's plenty of liquidity for me. And because I wasn't continuing to invest as an angel, I was, instead of recycling that money, as an angel, I was investing that money, via our funds or just taking it off the table. When the bubble burst, I had probably 24 months that I would just describe as utterly brutal. And, it wasn't just the internet bubble, but it was then 9/11. And then after 9/11, it was kind of a big correction at the macro with all the fraud with companies like WorldCom and Enron and all that.
Yeah, right.
Like it was a thing after thing after thing. And I sort of, my mess was sort of not cleaned up, but stabilized by the end of 2002. And at this point, I'm spending almost all of my time on the venture related activity. I'm not making new angel investments. And, some of the angel investments I'd put venture money into, and others I'm still helping and supporting where I can. But I'm not running around as an angel anymore. But that was a really powerful formative time that then turned into what I lovingly, with sarcasm, refer to as the grind, which was a period of time from about 2003 to 2007, which for me was just dealing with this very large portfolio of companies, some that were really good, but were, facing headwinds, others that were mediocre that needed something to happen, and some that were really not working, but were still alive. And just figuring out like how to work my way through that with the portfolio I had, along with the venture fund, which in 2005 was the end of our investment period. So we had to go raise another fund. At the very beginning of 2006, the remaining partners there, and of which I was one, decided not to raise another fund as a team. And as part of that, I committed to managing all the Mobius funds out through end of life. And we're finally shutting down this year, the 2000 fund.
Wow.
And, right. So, these are very, very long-term things you're dealing with. And if you sort of link back to an angel version of this, one of the very early investments I made as an angel, I think it was the 5th investment I made, was in a company called Harmonix. And that was 1994 or 5, I think early 1995. Harmonix is a great example of an overnight success that does not happen overnight. So for a decade, 10 years, Harmonix tried as hard as they could every year to go out of business. And they just managed not to. Like something happened. They got enough something somewhere to stay in business. I mean, they didn't really try to go out of business, but it was like
Right,
one of these
sure.
companies.
Yeah.
Every year, you're like, I'm going to get the letter, I'm going to get the call from the founder, who I'm good friends with. Like, we're done, we're cooked. There's nothing to do here.
Yeah.
And then in 2005, they came out with Guitar Hero.
That's it. I was trying to think of how I knew that
Right.
company name.
And Guitar Hero was an extraordinary success.
Sure.
And then, a year later, they got bought by Viacom MTV, and then they came out with Rock Band, and like just extraordinary success and an incredible return for the investors. But if you'd asked me in 2003, hey, is harmonics going to have any value? I'd say, no, probably not. It's probably a zero.
Yeah.
Right. Not because I didn't love what they did, not because I wasn't close friends with the founders, not because I didn't think there was real innovation there. I just no business.
Yeah.
And
Yeah.
they came out with that hit. And it was not just they got lucky with the hit, but it was sort of the confluence of a whole bunch of things they'd been working on, and iteration after iteration. What they were so obsessed, just in this case, around music and computers. So that was their whole focus. And somewhere along the way, they realized it had to be fun. And so then they started doing games with music on computers. And the early games they did were fun, but they weren't big hits, right? And, the second game was better than the first game, and the third game was better than the second game. And it wasn't until they combined this notion of playing the instrument with the guitar and Guitar Hero with the game that all of a sudden all those pieces came together. But it's such a good example as an angel investor where, like, I did 40 investments in that time period. Here's how I think of that portfolio. Again, 3 years, I did 40 investments. All of those investments were either 25K or 50K, right? So pretty much the same amount of money for all of them. 3 of those 40 individually were returned 100x my money, 100 times my money or more. So I had 3 investments that generated 300 times my money. Again, I'm consistent in the investing, so the math kind of starts to make some sense. 20 of them were zeros. But if all 37 of the other ones had been zeros, I'd still made 300 times my money against investing 40 times my money. Right? So it would have still been 8 or 9x return if everything else had been a zero. And the other 17, some I got 10% of my money back, some I got my money back, some I got a 2x or a 3x, a couple I got a 5x, maybe one I got a 10x. So it's sort of the benefit of time diversity, this portfolio being very consistent with the sort of investing dynamic, but then playing a very long game on these things. I was not like, I think the liquidity for harmonics, 1995 investment, the liquidity happened the first time in 2007 when we did the deal with Viacom, and then we got a part of our earnout the next year, so 2008, and then we had a lawsuit with them for 5 years to get the rest of the earnout, which was a very large number, which we eventually got most of, and that check showed up in 2013. So, the idea that it's a fast moving, like we've been in a cycle in tech in the last 4 or 5 years where there's a huge amount of velocity, tons of exits. You could put money in and have money back 2 years, 3 years later at a pretty significant increase. You had lots of secondary purchasing activity by VCs buying out early angels. Now we're on the other side of that curve. That's not going to happen for a while. But many of the angel investments that were made over the last couple of years that are now, in these companies, a number of those over time will be valuable.
Yeah.
The mistake an angel investor would make right now would be to stop investing.
Yes.
The next wave of early stage investments that are early stage companies that are going to be big hits 5-10 years from now are the ones that are happening every day, every week, every month. Like, you just have to stay in the game.
Yeah. So it sounds like that experience you described of the 40 companies is that formula that you always hear from VCs. Out of 10 companies, right? 2 or 3 are going to do nothing. Someone will do okay, blah, blah. Then one will hit it out of the park to make up for all the others, right? That whole adage that so much of the marketplace is based on. Your numbers are almost exactly to the T.
They're consistent with that. The VC, the power law theory, which really became prevalent in the last decade, is that one, in a portfolio of roughly 30 companies, which is the typical size of a VC fund. There are VC funds that are 100 companies, and there are VC funds that are 10 companies. But if you use sort of an average size fund or median size fund of 30, the power law argument is one of the companies will generate all the returns. I don't buy that one company generates all the returns. I think that the power law applies, but I think it's a couple of companies. And so I think in a really healthy venture portfolio, you want more than one company driving the bulk of your returns.
Sure.
And the other end of the spectrum, you're going to have a bunch of zeros. That's normal. There's a bunch of VCs, I'd say that, or there's a category of VC that's like, if the company's not working, getting your money back isn't worth the effort, or getting a little bit of return isn't worth the effort. And my view is actually that's wrong, because essentially, even though that individual company didn't have a big return, 2x, 3x, or whatever, it would be, all additive to the fund portfolio. And what it does is it lowers the cost basis effectively by returning some of the capital, that those big investments then build your profit. So the more of the fund you can return with the stuff that didn't really work, the more the profit comes from the big winners.
Sure.
So, I've always had a view that, there's the portfolio view, but then there's also just the personal view. Like, I like to fight hard to try to have the things be successful.
Yeah.
And, I accept that lots of things that are not going to work. They're ahead of their time. They make competitive mistakes. You have the wrong team, whatever the reasons are. But like, just because it's sort of not taken off, it gets to a certain level and then stalls. Like, okay, well, can you reinvigorate it? And I'll end this rant with, there is a conventional wisdom that once you get to a certain level, if it's not continuing to grow like crazy, it's never going to happen again. And we've had the counterexample of that with a number of companies where
Sure.
the company stalled and you had to do something. Sometimes it was change the leader. Sometimes it was buy a company that added new products. Sometimes it was sort of change a big market focus or come out with a new product that was very deliberate, where you knew you were trying to reinvigorate what you're doing. And if I cycle back to Harmonix, great example, right?
Right.
Like, until they had that hit product, like, the company was not worth much.
Right. That's what I was going to ask you. So, in that case where they're almost, oh no, like this. So when they had this product and they had the market fit, they had to raise capital in order to launch it and introduce it, right? So is that one of those that you kind of went back in and said, all right, let's go ahead and give this a go?
Really. Not really. In Harmonix case, they only, I think, raised a total of about $10 million over the life of the company.
Wow.
And they never really raised any meaningful VC. VCs didn't,
Yeah, because they took too long. They were taking too long.
Well, they couldn't get VCs to invest in. Oh,
Right.
you're a music game company. Who gives a shit?
Yeah.
So, they raised a bunch of money from angels early on and a couple of financings, and they kind of, got to a certain level. And that certain level was one where they were as long as they could sell a game idea and get an advance,
Yeah.
they could kind of stay alive at some level. And that's not a business that has much value until you have a game that actually becomes a success. And they were sort of stuck in this modality, but they could kind of fund their existence as a 40 or 50 person game studio with the next game based on their trajectory and the critical success, not the financial success, but the critical success of what they'd done over that period of time. And Guitar Hero was their first game, which they funded with in advance. But it was the first one, I think, of all the games that they ever did that earned out the advance. And I think their first royalty check for it was like $4 million, and that was the biggest check they'd gotten for any game, like not just individual check, but across all the things they'd ever done by a wide margin.
Yeah.
Right. So, different businesses had different things. And I think as an angel investor, understanding what those companies are going to need in terms of fuel to grow, and recognizing that the market we've been in for the last 4 or 5 years is one where there's an abundance of capital. And the mantra is value equals grow as fast as you can. And, I personally don't think that's going to be the mantra for the next 5 years. I think there will be a subset of the market has that mantra, but there's lots of other ways to build successful companies versus grow at all costs and consume as much money as you can possibly raise.
So interesting, because during that period of time, there was a company that I was looking at investing in that had, it was because of the success of Guitar Hero. This company had a learn how to play piano with a software that game that went along with the piano, and they had created a branding joint venture with Hannah Montana, and Mattel was going to be bringing this out in time for Christmas and all that kind of stuff. But their cap table was really, really screwed up because they had just almost like perpetual friends and family kind of a thing. And I looked at them and I really thought their cost was really high to be able to, you know what I mean? I looked at it and I was like, not for me, right? And sure enough, they had some technical glitches and missed the Christmas season with their manufacturer, and
Yep.
it spiraled after that. They have sustained and now are and I have invested since then because they went to a more of a mobile type of product, an iPad type of product and stuff like that, and they're getting ready to kind of relaunch in a new thing that they're doing that's really exciting. So but I get I was shaking my head because like I remember all of that. I remember that so much. So let's switch a little bit and talk about the Foundry, right? So the Foundry group, it really interesting, this ecosystem with portfolio companies and venture capital firms and general partners. You've got Techstars is in there. You've got AppDirect, Matchstick Ventures, SeatGeek, which right now we all know everybody wants an alternative for event ticketing space. And I'm in the same age group as you are. And I remember back in the days when we would actually wait in line to, get a ticket. And
Overnight.
we would go like to some concerts. We would drive 45 minutes outside of Atlanta to some Hobunk place to go and wait in line there because we could beat the line that they might have down in Atlanta, and then we'd all be like, we got into this thing and the monopoly and all of that we're dealing with right now. So all of that is really exciting. The Foundry group, that network it seems like it would be just a natural evolution of all your successes and relationships established along the way and just formalizing what you maybe informally had been doing for so many years.
Yeah, the simple way to think about it is we started Foundry in 2007. There were four partners, and we raised a $225 million venture fund, and we just started investing at the early stages like we had been, but via Foundry as the fund vehicle. At the same time, personally, I have been investing in venture funds with my own money going back to 1997 when I lived in Boston. And in 2004, after the internet bubble settled down a little bit and there were starting to be new venture firms getting created, I started investing in essentially the funds that were getting started with people who had been VCs before the bubble. So sort of this category called emerging managers. And I made a bunch of investments with my own money, and Foundry itself was viewed as an emerging manager. We raised a series of early stage funds every 3 years, same size, $225 million. And then in 2013, we were one of the very early funds to raise essentially, we called it a select fund, but it was a fund for Series B, Series C, Series D investments in our existing portfolio.
Okay.
But at this point, there's starting to be a lot of venture funds getting created, especially with first-time managers that have never run a venture fund before. And we're investing our own money in those things, those funds, but it's overwhelming. Like it is a hobby for us. It wasn't really part of our business. And in 2015, we had our largest LP in our funds, a guy named Lyndall Ekman, joined us from University of Texas, UTIMCO, which is where he was. He ran their alternative investment program. And we decided to institutionalize, as part of our funds, investing in other venture funds.
Okay.
And so today, 75% of our capital goes into companies, startups, and 25% goes into this group of venture funds, of which there's about 50 that we're partners with. And the vast majority of the investments we make directly are ones that are Series A or Series B investments, occasionally a Series C, Series D investment that one of the partner funds is a seed investor in.
Okay.
So our strategy shifted from running around the country looking for new things to invest in, companies to invest in, and to more working closely with all of these partner funds And they would typically be investors in the seed and Series A. But by the time they get to the Series A or pre-seed, seed, Series A, by the time they get to the Series A, if the company's starting to look interesting, starting to work and fits within an area that we feel like we have some expertise, those become logical direct investments for us. So that's how you should think of, one should think about Foundry. And then Techstars I co-founded in 2006, so the year before we started Foundry. And I'm on the board, and my partners at Foundry are we're all investors through our funds in all different aspects of Techstars. But I don't have an operational role in Techstars. It's run by a woman named Maëlle Gavet, who's extraordinary, and then David Cohen, who's one of the other co-founders of Techstars with me, is the chair. So it's something I'm very proud of, and something I continue to be, meaningfully involved in, big owner of. But the first probably 2006 to 2013, 14, I was pretty heavily involved in it as we were figuring out what it was going to be. But once it got to a certain scale, my role shifted from never an operational role, but a more heavy involved in the organization role, and today more of a just guiding board member role for it. Just for people that don't know about Techstars, it's we have probably 3,500 investments that we've made around the world. We run about 50 accelerator programs every year, and I think a dozen countries, with some with corporate partners, some in different geographies. And it's a very deliberate and designed sort of program where we invest in the companies and then have a 90-day program that they go through. That's the accelerator program. But part of the goal is that once we've invested, we're on their cap table and part of the company, and we try very hard. Techstars tries very hard to help the companies through their entire life.
Yeah, it is. It's sort of kind of the gold standard with other investors. Speaking from the Southeast, it's like when a company says, "Ah, and we went through the Techstars incubator or accelerator program." It's like, "Oh, really?" You have a comfort level that there's a knowledge within it, within the organization or within that founding team, that they've got some idea of the blueprint that they want to go on to fully kind of get launched and growing. And so many of the other incubators and accelerators try to model after that. I think we here in Georgia, the Atlanta Technology Development Center, we had an organization where it had a small VC that would put that very early money in, and then it's in a similar fashion for those companies that were coming out of that. It was kind of modeled after Techstars, so that's really great. So as we start to wrap up here, I want to say, so personal passions, collecting art, long distance running. What I got was 25 marathons as part of a mission to finish a marathon in every state. What are the updates for that? Where are you on that journey? And why did you start, and why, other than like stress relief, because, oh my God, I got all this stuff going on, or it's when I get to thinking about really the potential of these companies? Is it just sort of your own sort of harmonious time when you're running? What is that all about?
Yeah, the update is I did New Hampshire last fall, so I've got 26 states knocked off the list at this point. I love to run, and my idea of a good time is a trail run for 3 or 4 hours in the mountains. It's just I just love sort of being there, being in that zone, being in that physical state. My daily, weekly running is consistent and significant. I don't care about time. One of the reasons I like to run trails more than I like to run roads is because if you're on the trail, you actually can't care that much about time because of the unpredictability of the trail. And I love to run alone. A lot of people say, "Hey, let's go for runs together." I'm like, "Yeah, no, not really. That's not what I want to do. I just like the space." And a good example would be this morning. I mean, I had a late-ish for me night last night. My wife Amy and I are both early birds, and I had a thing out at dinner, and I got home, and I still had a meeting late. I went to bed, and my brain was not completely unwound when I laid down to go to bed, and I got a good night's sleep. But I woke up this morning, and there's still stuff stirring around, and I went out and I ran for an hour, and like just the physiology of feeling differently after that is a big part of what keeps me, in a happy happy place. It's not functional in terms of working out things while I run or thinking about stuff or anything like that. And I usually don't listen to anything when I run. So it's usually just, I just run. Although, there will be times where if I'm doing a long run and I'm on the roads, maybe I'll listen to a book or on tape. And sometimes I need some, I get bored of listening to the book on tape or on Audible. And so I, put on some Rush or put on some Girl Talk or something that's got a beat to it that, will kind of keep me going when I'm starting to fade.
Yeah. So good. So great. So excited again for you to be a guest on the Compassionate Capitalist Show. And everybody, all the links will be in the show notes. And thank you so much. And anything you want to add that we didn't cover by
No,
chance?
this was fun, Karen. Thank you. And thank you for being an angel investor and helping lots of startups. And to anyone listening that's an angel investor, keep at it. It's awesome.
Yeah. Go get my book. That's the thing, right? It's a primer for would you, should you, could
Go
you.
get Karen's book.
So thank you so very much, Brad, and onwards and upwards.
All right. See ya.